Are we on the verge of a taper tantrum? Also, what is that? What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown. Today we are talking about the increasing frequency in which we're hearing talks about tapering coming from Federal Reserve officials. So we're going to talk about what is tapering, what will that do to the markets, and third, what is the likelihood that it starts to happen anytime soon. Ready? Let's dive in. All right, so a couple days ago, the Federal Reserve minutes came out from their last meeting, and it looks like some people were saying, hey, it might be time to start thinking about talking about raising rates or decreasing our asset purchases at some point soon. And the reason appears to be they were saying, hey, if inflation gets too far ahead of us, we don't want to be caught off guard. We want to be ready to do something about it if inflation outpaces our expectations in severity or in duration. And on Friday, the Philadelphia Fed Bank president said that they should start talking about the best way to reduce their asset purchases sooner rather than later. Again, keep in mind, talking about it sooner rather than later, not actually doing it sooner rather than later. So if and when the Federal Reserve finally starts to taper, here's what that means. First step is that they stop purchasing as many assets as they're purchasing right now. Right now, they're purchasing at least $120 billion worth of treasuries and mortgage-backed securities every single month. So step one would likely just be slow down the rate of purchases. Not stop purchasing, not start selling, just slow down the pace at which they are purchasing these assets. The other step that could come fairly early, which could either be before or after or in conjunction with, would be raising the federal funds rate. One of these or both of these happening would both have the effect of essentially just increasing interest rates across the yield curve. Right now, the fact that they're purchasing so many assets means that lenders don't have the opportunity to outpace inflation when they lend money. That means borrowers are able to borrow money at or below the rate of inflation, which is essentially free money. And the reason that the Federal Reserve is engaging in this policy right now is to make money easier for the economy to get their hands on. They want cities and states and people and corporations to be able to get their hands on money easier, make the cost of getting money very low, because if you can get your hands on money through debt, then you can spend that. And their thinking is, if that money is borrowed and then spent, that'll stimulate the economy, cause some growth to happen, and nominally increase GDP and wealth enough to offset the negative effects from the growth in debt. It's flawed thinking, but that's how they work. The dangers with this monetary policy is overheating. It's inflation gets away from you and starts running out of control. Because if money is so easy to get that everybody's getting money and then spending it very quickly, you can very easily lose systemic confidence in the currency. You can see a very quick collapse in the purchasing power as nobody wants to hold on to it anymore. And so that has been the reason why some of the Federal Reserve officials have been saying, hey, we need to start talking about what our plan is if inflation gets away from us, or if inflation starts to exceed our expectations, so that we have a plan to wind this back and stop contributing so much to the overabundance of money in the system. Now, here's the problem with this. The Federal Reserve, like I've said dozens of times, has gotten themselves in between a rock and a hard place. They are basically choosing between sacrificing the purchasing power of the currency or maintaining the dollar value, the nominal value of assets like bonds and stocks as a result. At this point, it's kind of one or the other. And one of the key markers the Federal Reserve is watching is employment, simply because due to the Federal Reserve Act, that is one of their two mandates. They've got two mandates given to them by Congress, which is stable prices and full employment. And at this point, given what's happened over the last couple of years, and especially recently over the last couple of months, it looks like those are at odds right now from their current perspective of how they engage in monetary policy. Because in their effort to maintain stable prices, which in their mind is actually rising prices, they've actually contributed negatively to employment. It turns out that when you give people paychecks and pay people to stay home, sit on the couch, and watch Netflix, that's what they'll do. And it bears repeating that this was actually the intentional policy to deal with the pandemic. Get people to stay home, give them money so that nobody has to leave. Well, guess what? It worked. People aren't getting jobs anymore. People make more money on unemployment than they can with especially entry-level jobs. That's why you're seeing employers all over the place shutting down early, closing their doors on weekdays or sometimes even weekends, lines out the door because nobody can hire enough people, because nobody wants to work. Is that hyperbolic? Of course it is. But intentional unemployment is a symptom of too much money in the system. And that's a problem because one of the key factors that they're looking at before they start to taper is full employment. And even Harker, after he said, hey, we need to start talking about this sooner rather than later, said that they need to see continued strength in the labor market and the addition of many millions of jobs before they start actually tapering. And so given what they're looking at as a metric or a measurement to say, hey, this is when we can start tapering, employment, and given the fact that Powell is at the helm, and Powell was the one who made the decision a couple years ago to start raising rates, winding down the balance sheet, aggressively starting to engage in deflationary monetary policy, or at the very least disinflationary monetary policy, and he took a lot of flack for that and had to reverse course. And given the fact that he is nearing the end of his term and he doesn't want to accidentally reverse course and have the last thing that he's in charge of at the Fed being the same thing that he did at the beginning, causing maybe potentially a deflationary death spiral, which is the last thing the Federal Reserve ever wants to see, my expectation would be that they increasingly talk about tapering and increasingly talk about it publicly, but they don't actually engage in any sort of tapering or even reducing their amount of asset purchases until after Powell is gone. However, if they do, we're going to see continued lockstep between bond prices and stock prices. You're going to see rates shoot up, which means bond prices are falling. And given how over-leveraged our economy is, that will have a direct result on the stock market. So it seems very easy, in my opinion, for tapering, even slightly, to be a trigger. All you need is a little trigger, a little catalyst for a deflationary crash to start to take place. And so if they do decide to slightly taper, I would anticipate you'd start to see massive sell-off in assets across the board, which would most likely then prompt a swift reversal in course from them, and they would start buying up assets again. They would drop interest rates. They might even engage in full-blown outspoken explicit yield curve control and push all interest rates across the curve down to zero. But given how much it seems like they don't even want to talk about it yet, I would doubt that any actual tapering takes place in the next year, 2 years. But I've been wrong plenty of times. I've been surprised plenty of times. And if we do see tapering, even a big amount of tapering, they start selling their balance sheet. There's a deflationary death spiral and a huge crash of assets all across the board. Real estate prices come tumbling down. The stock market comes tumbling down. And we can finally see some real rebuilding and some real economic growth take place after that. After you burn out the deadwood from the system, you allow all the malinvestment to get wiped out. A lot of fraud that is a spawn of easy money gets cleared out. And then asset prices are finally cheap again, which is the best thing that can happen for poor people. You give young people and poor people the chance to buy assets that are on sale. So I don't think it'll happen, but if it does, it will be a welcome surprise. As always, if you guys liked the video, please hit that like and subscribe button. I really appreciate you. Have a good day.